What's going on, you guys? And thank you so much for tuning in for an episode of The Mortgage Mindset. Hey, real quick, I just want to remind you that we do not run any advertising on this show, and we are looking to grow it organically. So we cannot do that without your support. So if you find value in the show, if you got some information that you found really useful, please share the show, send it to somebody that you think might find some value in it as well. So without further ado, let's get to it.
What's going on, you guys, and welcome back to The Mortgage Mindset. I'm your host, Trevor Otsuka. I'm a licensed mortgage advisor with Harmony Home Loans in Las Vegas, Nevada. I also do commercial lending through ComLoan, and I'm the CEO and founder of Keyframe Media in Las Vegas, Nevada. Today, we are on a solo show. I do not have a guest, so we're going to make this one super short, really sweet. Let's jump right in and talk about the market update. So today is Friday. It's December the 1st. I hope that you had an amazing Thanksgiving with your family and you got to spend it with the people that you love, surrounded by the loved ones. For today's market update, we actually had a really nice week leading up until today. I think it's the first time since I can remember that we had positive rate improvements for multiple consecutive days in a row. I think it was 4 or 5. And then yesterday we took a little bit of hit in the market. Then today we pretty much got everything right back. So we are looking at let's start with conventional 30-year fixed. Right now, 7.09% is the national average, which is great. So we are definitely cruising in a downward trend right now. We'll see how long we can keep this momentum. Next up, you have a 15-year fixed for conventional that is at 6.48%. 30-year FHA, 6.50%, which is great. And then a 30-year jumbo, 7.60. For 30-year VA, it is the exact same as FHA at 6.5%. Let's talk about economic data and what has been going on lately. Let me pull this up for you right now. So today we had ISM manufacturing for PMI. That one came in at expectations. That's why we had a little bit of a rally today. And then earlier this week, what do we have? We had a 5-year note auction, 7-year note auction. GDP came out. Core PCE inflation year over year and month over month. Those came in a little hot earlier this week. That was on Thursday. So we took us a slight dip. And then right back to gains territory today. Next week, we are going to have non-farm payroll on Friday and unemployment. So those are going to be huge market movers. We will see what exactly is going to happen with that. We have the JOLTS report on Tuesday, but really Friday is the huge day next week. That'll be on December the 8th, and both of those reports come out at 5:30 in the morning. A couple of things I want to update you on that is happening in the mortgage industry, projections for next year. So the first one up, it's confirmed that credit reports are going to become more expensive for mortgage lenders in 2024. So what they're basically going to do is they're going to we do a lot of our business, I do a lot of my business off of soft pull reports. I do this for 2 reasons. One, it allows me to protect your credit as the consumer because it doesn't report on your credit. It will not negatively impact your FICO scores, but it also allows me to see your true FICO scores that we will use to qualify you for the mortgage loan itself. And it allows me to see all of your trade lines, what their balances are, so that I can generate an accurate debt to income ratio. And I can also pull accurate pricing because I have the correct credit profile when I actually look at the loan program itself. But next year, what they're going to do is they're going to make soft pull credit reports cost equally as much as a hard pull report. So at that point, there's not going to be really any benefit to pulling a soft pull report. Right now, they cost significantly less. They're less than half the cost for equivalent to pulling a hard pull report. So I would anticipate that this will be ever evolving, but I would anticipate you're going to see a lot of lenders, a lot of mortgage companies moving forward that are going to pass that cost on to you as the consumer, which is unfortunate, but it'll be the nature of the business. So I'll keep you posted on that one. And then another big one is loan limits. Okay, so every year about this time, end of November, early December, the FHFA and FHA will release their updated loan limits. So let's see what they are. Conforming loan limit for 2023 was $726,200, and now it's going to be $766,550 for 2024. That'll be for a single unit, not in a high-cost area. For high-cost areas, that's going to jump up to $1.149 million. So that would be, high-cost areas would be like Los Angeles, San Francisco would be a high-cost area, places like that. For FHA, the floor for FHA loan limits for one-unit properties increasing to $498,257 in most parts of the country. Last year when they made this update, Vegas was slightly higher than that. So I will report back for you guys on a future episode once I get access to the FHA chart specific to Clark County in Las Vegas. So who benefits from that? Man, that's going to be interesting to see. Obviously you can do multi-unit acquisitions. So that might help you being able to purchase higher cost or higher value properties doing multi-units like 2, 3, or 4 units. You could piggyback that actually on the update for Fannie Mae that happened on November 18th, where they reduced the minimum down payment across the board for 2, 3, and 4 units as long as you live there as a primary residence. It's only 5% down now. So if you have the income to qualify for it, we could also use the projected rental income from the vacant units you're not going to live in to help you qualify for that for your debt to income ratio. So for those of you that have been looking to house hack, this could be a great opportunity for you moving into next year, just depending on what your individual financial situation is. So I don't have a guest today. There is no interview segment. So what I want to do is I want to share with you a little bit of insight that I received from my mortgage coach. His name is Amer Bali. Okay. And to give you some backstory, he was on episode number 3 of the show, and Amer he's a beast. And on top of that, he is one of the kindest souled people that I've ever met in my life. He went through a huge transformation as a person when a bunch of accusations came out against him that turned out to not be true in the mortgage industry. So he basically lost all of his business. He's now in a rebuilding phase and is coaching a ton of mortgage originators, a lot of real estate agents across the country, believe it or not. And he has so many insights. And one of the things that he told me was, Trevor, if your business is suffering, it's because you are having a lack of opportunities to be able to close loans. So the only way that you're going to be able to fix that is you have got to go out there and build new relationships and reverse math what you need in order to produce your desired income. So for example, if my goal is to fund 10 loans every single month, then I need to reverse engineer how many people I need to have conversations with as clients to get them qualified in order to get 10 contracts, 10 open escrows every single month. So if you are a real estate agent, if you are a loan officer, I highly encourage you to sit down and really dive into your goals for 2024. Another thing that he told me is that a lot of people take the month of December off. They are spending time with their holidays. They turn the holiday into a holla month. And December is actually the true beginning of the next year. So right now we are in the beginning of 2024. So don't sleep on the opportunity to get out there and continue to build your business aggressively this month and figure out what you need to do in order to get to your goals of 2024. Figure out how many contacts that you need to make, how many new introductions that you need to make, what new relationships do you need to start cultivating in your business to be able to successfully hit and maintain your goals in your business. So I love you guys. Thank you so much for tuning in and for sharing your time with me. I told you this one was going to be short and sweet, and I think we got through this in less than 10 minutes. So I will see you guys next week. Got some new guests lined up. And as always, I appreciate you. We'll see you next time.